What if I told you that using stop losses could actually be losing you money? In this video, we're uncovering the truths about stop losses that nobody tells you. When I was learning to trade, every book and video said, put in orders to limit how much you can lose on a trade. So I did that, and it makes sense, right? If you don't want to lose money, put in an order to sell when a stock goes down. Well, I kept losing money using stop losses, and I didn't know why. Then one night, I was watching my trading screen at 3 in the morning Australian time, and I saw a stock fall, hit my stop order, my position was sold, and then the stock bounced up. Interesting. When I woke up in the morning, I saw the stock ended the day up 4%, and I had lost 5% because my stop loss was hit. That moment sparked a deep dive for me into the real impact of stop losses. It got me into testing systems on actual data, so I didn't have to trust what the gurus were telling me. Using advanced backtesting software, I've analysed tons of data across various stocks and ETFs. What I discovered about stop losses is something you need to see. So let's jump into Wealth Lab, the backtesting software I use. To see what happens when you rely on stop losses, the answer might surprise you and could change the way you trade forever. So this is a system tested on the Magnificent 7 stocks, Apple, Amazon, Google, Meta, Microsoft, Tesla and Nvidia, over the last 10 years, and you can see it makes about 1.75 million, and it's got a drawdown, so peak to trough loss that's in the red here. Take off the benchmark of say 39%. Now that's without stop losses, right? So now I'm going to put in stop losses. So I go to the design surface here. I've got sell at 10% stop loss. I'll just turn that on 10%. Now watch our backtest results change. Currently 1.8 million. See what happens. 760,000. It's much worse with a 10% stop loss, right? What about the drawdown? 39%. It's the same. So in the worst case, we lose the same amount of money and we make less than half as much money with a 10% stop loss. Now we'll go back in. Okay, maybe the stop loss is too tight, right? I hear you saying maybe. So we'll go from 10% to 20%. Run this baby again. And okay, so now the profit's back to what it was previously, basically, without the stop loss. But the losses are the same. So with a tight stop loss, we do much worse, and our drawdown isn't any better. With a 20% stop loss, a fairly loose stop loss, we do exactly the same, right? So now that's on the Magnificent 7. So what we're going to do now is change to a totally different set of stocks. Well, actually ETFs. We're going to see down on the left here, we're going to go to commodities. So with commodities, we'll go to the data manager, my commodities set. So it's just 4. So I've got DBA, that's agriculture, an agriculture ETF, DBO oil, gold, and then silver. So we'll go back to the trading system. We'll have 25% position sizes because we've got 4 ETFs. And then we'll rock this baby, run it, and what do we get? Yeah, it's not that great, right? It's pretty rubbish. Goes nowhere, but that's what these 4 commodities have done on average. You've had a bit of a run in gold at the end, and so stocks are much better than commodities in the long run. This is just the last 10 years though, right? That flat part at the start is because it's a moving average system and we need 200 days to get it started because that's the longest moving average. But anyway. So that's with, what do we have here? That's with a 20% stop loss. Now we'll take the stop loss off, have a look again, and what happens? Okay, it goes down a little bit, but hardly changes. Drawdown's 23%. Now, why don't we put it back on and just use a 10% stop loss, a tight stop loss. So 23% drawdown and $105,000. Basically, it goes nowhere. We'll run this with a tight stop loss. Hardly changes. Drawdown. What happens to the drawdown? Well, a little bit better, but so in that case, it helps slightly, but the stocks don't go. The ETFs don't go anywhere anyway. So, I mean, I could go on and on with lots of different groups of stocks and lots of different ETFs, but the main lesson, and you have to test yourself, or I can test for you if you want, but the main lesson is that a stop loss generally doesn't help. It might help with stocks that are volatile or go down if you have a crystal ball and you know they're going to go down, trend down over the long term. But for growth stocks, like the Magnificent Seven, it doesn't help to get out on random fluctuations. And that's what the stop loss does, right? If you've got a random fluctuation, as I found out at 3 o'clock in the morning in Australia in my initial story, if you have a random fluctuation, you can get cut out of your position by the stop loss, and then the stock bounces back and you're out of the position and you miss out on the gains. So you really need to test your systems, but what I've found testing thousands of systems over the last 25 years is they generally don't work. And I use stop losses on none of my systems. None. There's not a single system I use stop losses on. So how do you get out of the position? I hear you asking me maybe if I can hear you through the TV or your phone. You get out of your position when you think the trade's wrong. And how do you know when the trade's wrong? It's based on your system. So in a moving average system, you get out of the position when the moving averages cross. If you've got a more complicated system based on volumes and flows or even economics, when those volumes and flows and economics change, you get out of your system. You don't just put a hard rule stop loss in, but you'll get hundreds of books and hundreds of videos telling you to use a stop loss, because a lot of those people, Jesus sounds rude, but I'm telling you the truth, a lot of them do not know how to trade. And I bet they don't make a lot of money trading for a living. Stop loss sounds easy, it seems to make sense, but it just gets you out of your position with random fluctuations and you miss out on the big moves. Or it saves you if you know a stock's going down, but if you know a stock's going down, you shouldn't be in it in the first place, right? And nobody's got a crystal ball. So that's the end of this video. Thank you very much. Please subscribe if you liked it, and see you in the next video. Cheers.